Thanks so much for tuning in to today's Talking Point. I'm your host, Niraj Shah. Guest today is Mrinal Singh of Incred. Mrinal, great having you. Thanks for taking the time out.
It's a pleasure always, Niraj. Thank you.
Now, the pleasure is ours. Mrinal, a bit of, you could say a bit of a tug of war between risk on and risk off, so to say, but the market's largely not going anywhere. Now, what is, to your mind, the next set of triggers coming from? Is it global factors which, if they turn benign, help risk assets largely? Or could it be a factor of what we do in quarter two in earnings, which could be the principal driver? What happens next?
So very clearly, the global macro is weighing down on the market, and elevated crude prices are kind of worrying the projections. We also have a election domestically. We've already announced election for the 5 states, and we have the general elections. So the market is obviously a bit more, nimble-footed. Clearly, but the earnings season that we've entered matters a lot more from a medium to long-term perspective. No doubt about it. But then the global macro combined with the local, I would say uncertainty because elections are almost there. I think that is what is keeping worried. Also, participants are getting a bit jittery because maybe they expected the interest rates to come down faster, wherein the global central banks continue to remain hawkish, and that's due to the inflation being where it is and crude being higher for things in Middle East or even war in Europe. I think that is kind of worrying investors. So we are seeing a range-bound market, particularly because the earning trajectory is positive, but the macro is clearly weighing on the market.
Yeah, and you reckon, Mrinal, therefore, that it stays that way for a better part of the next couple of quarters because the election anticipation overhang, by the time the state elections are over, we'll enter into the national election season, so to say. So does it kind of stay as an overhang which caps any possible upside, if you will?
Well, in simplistic terms, it would be an extrapolation of current environment, but generally I've seen the markets don't work like that. The markets generally don't believe in being stagnant. They will either break through this, the trigger could be upward, it could be earnings, or it could be mulling down of the global macro concerns, or they will adjust for those concerns and the prices will come down. So the equity markets don't have a habit of being dormant. They will not remain dormant for long. They will obviously accept one version of either the concern or medium term India perspective.
Got it. So could it well happen, Mrinal, that the broader end of the spectrum, where in specific pockets due to earnings growth or due to triggers by the government? I mean, there was a note of how the next 6 months the road awarding will actually pick up even more. And that might well play into the hands of the government wanting to do something for the rural consumer, right, per se, because that is clearly ailing. So could it well happen that the indices by and large stay kind of very range bound, but specific pockets would have sharp reactions either on the upside because of policies or downside because of earnings disappointments?
So excellent observation, Niraj. I think that is exactly what we believe is going to happen. Calendar year 24 belongs to the rural consumption. Clearly, that has been the lagging part of the economy. We've always seen that approaching election, the government becomes a dominant player in the economy through spending, through MSPs, through elections, whichever way you want to call. Their policy framework clearly moves in that direction. And there is genuine need for the government to intervene to pull the rural folks out of this slug that they've gotten into. So I have no doubt that the calendar year 24 belongs to rural consumption. And all businesses generally have both an urban phase and a rural phase, but some businesses have a bigger rural phase. Those are the ones which have been struggling last 3 years post-COVID. And those are the ones potentially which could do better going ahead. And it's not only about a year. Rural is more than 2/3 of the population. It's almost 60% plus of the volumes across sectors. And India growth story is about penetration, and that is the uncharted place where goods and services haven't yet reached. So I guess the genuine growth, the real growth is where we would walk into the next calendar year.
The skeptics of this argument, Mrinal, are arguing that it is flattered to deceive a couple of times in the last 3 years. And yet, if you want to buy into let's say, for example, staples, which could be a part of the rural consumption story, then you're paying a significant premium for not so significant a growth number. Uh, what would the response be to such an argument?
So, well, that's a valid fundamental query, or I would say at times, very often in investing language, disgust. Because very good businesses price too well, so all investors want to buy them at a price. We've been watching them forever. But that rural is not only about staples. There are businesses, for example, two-wheeler is a very rural business. Some people miss, but the largest portion of cement consumption is in rural. So, well, there are plenty of sectors itself which are very rural heavy. Staples is definitely going to gain, but then if the valuations are uncomfortable, there are other sectors which we are looking at as well. I named a couple, and there are plenty of others which also have a rural face and could benefit.
Yeah, well, that's true. Okay, so let me try and expand that bucket and just probe that a little bit, Mrinal. Uh, so, for example, building materials could well fall into the argument of gaining from rural, but at the same time, having substantial benefits from the ongoing residential upcycle or infra spend by the government, both in rural and urban. Would that be a safer pocket? Part one. But part two, is it being captured in the valuations, or do you reckon there is room for positive returns into, let's say, for example, building materials as a pocket?
So, well, let me shake people a bit on that. I think what has started happening in last 10 years, the growth has been so meager that I feel that people have started thinking small. People are not realizing where we as a society, as an economy got to go is going to be multiple times from where we are. I mean, if you're trying to look at 3 months, 6 months, you might see some percentage growth and all that. But if you start thinking 5 years, 10 years, you'll realize that we are talking multiples from the size we are. So is building materials going to be 3 times the size in next 7 to 10 years? The answer is yes. If the economy is going to be double, and a lot of it is going to be led by infrastructure, housing, and capex, I have no doubts that building material will be a significant part of that growth. And because of last 7-10 years or maybe a bit more, we have had meager growth in the system. So we've started thinking small is what I have, kind of sense. But I guess we just need to expand the horizon both in terms of size and scale. We are looking at multiples in the economy. Our economy is roughly 4 trillion, give or take some. We are going to be 6 to 7 trillion very, very soon, in the next 5 years maybe. I mean, we are talking about very, very large economic activity being added. So people need to think in those lines. Thinking 5, 7, 8%. I guess they're going to miss the bus. You have to think that where is it going? Where is the growth getting driven from? If the economy is going to double in the next less than 10 years, then there are sectors which might actually do far, far better than that.
Got it. Okay, so let me try and ask you a bit on that. Uh, there would be themes within this growth in economy beneficiaries, which would be discounting a lot of the near term and maybe some medium term benefits in the current valuations. And then there would be some which are still not being played because maybe the near term might be a bit sluggish for the next 3 to 6 months, but then the long term comes into play, as you say. My question to you is, where is it that you are betting the larger portion of your current portfolio on to play that game?
We call it mean reversion. So there is a set of sectors or the economy which has driven the growth in the last 3-5 years. Urban has been a dominant part of it. But I think the next 4-5 years, capex, for example, has been lagging for 10 years. I think the next 10 years, a lot of capex will happen. Then we will see the rural part of economy kickstarting somewhere next year. The green shoots are already there. We will see building material, manufacturing oriented, consumable business. There is going to be mean reversion into sectors like healthcare. And by healthcare, I don't only mean pharma. There is an entire umbrella. We have got diagnostics, we've got insurers, we've got hospitals, and we've got more. I mean, healthcare is a very expanded sector now. We don't have a great representation on education. Otherwise, that's also a place where households will significantly spend. Entertainment, travel, and leisure is going to be a large part of spending as household incomes move up. It's historically seen in every economy. It's going to be no different in our household economy. We are going to see government-led infrastructure push. Last 15 years, we've seen highway, port, airport kind of things. I think urban infrastructure, mass transport system, expressways, that is the place that the governments will spend in the next 10, 15 years. So there are plenty of places, very, very brick and mortar. Obviously, financials will benefit. Housing finance is a very great area to be. I think the runway is very long and strong. We also think telecom and infrastructure related businesses would be interesting. It is a challenge from a equity perspective to invest in infrastructure. So we do all kinds of roundabout things around it. And I also feel that there is too much of talk about US recession. I think US Fed is particularly very well placed. They can deal with a recession if at all it happens, or a slowdown, if I may say. Because the Fed rates are at 5.5, they moved up from zero to that number in less than 18 months, somewhere in that vicinity. They're pretty comfortably placed to take it down if they need to support the economy. And I guess the seeds of next technology growth engines are already there. AI is going to drive things for the next 20 years. It is going to meaningfully change everything that we do and conduct. Like internet has changed everything that we do and conduct in the last 20 years. So would be things like drones, so would be things like IoT. So there is plenty. It's just that, as I said earlier, it's just you have to just look ahead of the hump. Start thinking a bit farther, and you think there is plenty of sunshine around.
Yeah. So actually, I was going to say that this is a very diverse set of themes that you've given us, and a lot of these could benefit, some more and some less. If I were to, for the benefit of our viewers, try and understand where is it, Mrinal, that you are particularly focusing on, and it may not be necessarily just by the weight that you allocate in your portfolio, but could be because you are thinking slightly differently than the rest of the street. So may I ask you to tell us where is it that you are particularly focused on, more so when you might also be a bit contrarian, and why?
Auto ancillary, very clearly, very large ecosystem and very capable businesses. And you have choices of valuation and management. Cement, very big pack. There are large names, there are mid names, there are small names. There are industrial consumables, power utilities, and capex oriented businesses. Housing finance, clearly a favorable stock or sector for us. These are 3, 4 spaces we are very gung-ho about, and obviously we have taken our names in terms of our choices of investment over there.
Interesting. Auto ancillaries. So just probing one or two more. And hitherto in all of these pockets that I've heard you say, I haven't heard IT services. So that will be my last question. Though you did mention IT, but not IT services. So that will be my last question. But before that, auto ancillaries. Uh, the nature of the auto industry is shifting meaningfully. We're already seeing that big change in India in two-wheelers and globally on the four-wheeler side as well. Do you reckon the traditional favorites could well make segues into electrification or hydrogenation as the case may be? And would you bet on some of those, or would a completely newer set of auto ancillary names dominate the gains for the next 10 years?
So, well, the future of mobility is green, no doubt about it. Is it electric? Is it hydrogen? Is it something else? I think the science and economics are still trying to find it out. The final call is not done over there. It could be a combination as well. But no matter what it is certain that it is green, and there are some natural trends that we are seeing. Electric vehicles are heavier, so they need similar kind of adjustments in the car. The wear and tear of tires are more steeper. We also need, we are talking about automatic driving at some time, self driverless cars. So we will need safety devices. Car designs will change in a way that, backseat drivers would be the whole idea of, as of now, most cars are designed globally from a pleasure perspective, performance perspective. But then it will become something, where there is no driver, but you sit behind. So it will be designed in that respect. No matter what it is, there are lots of trends in the mobility, but there are some things which will remain. A heavier vehicle needs some bit of better cushioning, some bit of better, shock ups. They need tires to be of a different variety. We need safety devices to go up. That's a trend irrespective. Even if there is delay in adoption of greener mobility, we will see safety devices, because now we are seeing expressways permitting in India 120 kilometers per hour, which used to be 80 kilometers per hour. That would mean that by law, you will have to have better safety devices in car. Otherwise, we will have more accidents. Historically, there have been very high fatality rates in India due to accidents. So that's something that I'm sure the government is aware about. We will see that trend. There would be need driven by regulation, driven by demand for safer cars. There would be need for more DC motors because people want more electric chairs. They want the bonnets to, move up and down on their own. So those kind of comfort effects. So we clearly have an ancillary ecosystem. Neeraj is so large and so capable. I mean, you can have people specialized from locks to DC motors to indicators to cameras, and there are businesses who just do that, and they keep improving their product and go to market value match with the clients. So plenty to choose from, and it actually creates no conflict in terms of which way the mobility future is going. It could be electric, it could be hydrogen, it could be something else, but there are some things that are not going to change. So that leaves plenty of space for us to choose to invest in. Other way to split it would be, two-wheeler and four-wheeler. And in two-wheeler, four-wheeler, there are mass two-wheelers, there are mass four-wheelers, where there are volumes. That's where we are focusing on because it gives us a rural exposure as well. Two-wheeler is a very heavy rural product. And I guess as and when rural does pick up, it will show up in those volumes. And the entire supply chain will kickstart.
Got it. Mrinal, we are very close to wrapping up. So 60 seconds, but just 60 seconds, a word on IT. What did you think of TCS result? What the call ahead?
IT great businesses. I think they are going to, for the timing, show some growth related issues. But for a price, we would definitely look to invest in them. They are very well poised to drive or facilitate their customers move towards the new engines of growth like the AI and the IoTs and all. So we will obviously add them up for a price, and I think somewhere in the next 6 months we might just get that price. We will look to add them.
Got it. Great. Mrinal, we'll leave it at that. Thank you so much for taking the time out and being with us on Talking Point today.
Thank you so much, Niraj. Thank you.
The pleasure was ours. Viewers, thanks for tuning in.